Hello and good morning from the Bay Area. Welcome to the Coinbase Institutional Market Call. It is Wednesday, August 9th. My name is Joshua Pack. I'm a trader here at Coinbase, and I will be your stand-in host for today. Ben, if you're listening, we hope you're enjoying your time away, and I will certainly do my best to moderate our discussions here in the coming weeks smoothly in your absence. As always, we have a star-studded lineup here for you today, and while it has admittedly felt to me to be a little bit of a quieter summary-style week in terms of news and flows, we're happy to take advantage of these less hectic times to dive deeper into broader industry trends for institutions with an exciting lineup of guests, while of course sticking to our normal programming and walking you through all the movers, the shakers, and the newsworthy items from the week. To start our conversation today, our special guest for this week is Rick Schonberg, a product director for Coinbase's institutional product platform. He's going to spend some time walking us through today a few things about different execution algo tools popular amongst institutions. Difficult liquidity conditions can make trading institutional size feel like you're trying to fit a block through a pinhole. So we're excited to have Rick here today to talk us through the work he and the team are doing to ultimately create best-in-class trading tools to help traders achieve best execution outcomes. Georg is then going to give us a market update, chatting through the market dynamics in ETH, altcoin performance, stablecoins, and much more. As usual, our in-house econ and macro professor, David Duong, is going to share with us his macro picture for the week, talking about the recent yield curve steepening and the potential impact this has on crypto assets, as well as sharing his thoughts on the ongoing inflation debate. Trish is then going to walk us through our desk flows and notable trends that he's seeing. And lastly, we're going to close it out with a conversation with Sid, who's going to give us an update on the curve situation, as well as talk through some interesting metrics around base. If you are watching on YouTube, don't forget to scan the QR code below to get access to all of David's best-in-class market research. And if you're a podcast listener, this information is posted in the show notes. On this call, I think everyone who's with you here today, we're all passionate about increasing crypto adoption across institutions. Broadening the reach of our market discussion topics is one of our ultimate aims. So please don't forget to hit subscribe and rate our discussion, which is really the best way for others to join into our conversations here and learn more about this podcast. That is a lot of me talking. So with our announcements out of the way, let's get right into it. Rick, welcome to the podcast. We're so excited to have you join us today. I've heard really wonderful things about your passion for food and your culinary skills. I know that's a discussion for another day. So start with your day job and all that you do. I thought maybe you want to start with an intro into yourself, your background, and your role here at the company.
Sure. So hi, Rick Schonberg. I help run institutional product, at least the trading vertical here at Coinbase. I've been at Coinbase for about 3 years. Before that, I've spent the better part of the last 30 years in financial markets, electronification of markets, mostly in FX. Majority of that time, about a decade, both at JP Morgan and Goldman, where I helped launch Goldman's EFX business in the mid-2000s and then their algo business in the early 2010s. And at Coinbase, again, I help work on our crypto, algo, and electronic trading tools for our clients.
Awesome. So a perfect background fitting for our business, which is awesome. So I guess we'll jump right into it. So I know that you and the team have been working really hard to release our new VWAP algo, which I'm sure you're going to dive into. But before we dive into that one, I guess, did you want to give a little bit of additional background color and talk about the various steps it took to get here? Maybe talking a little bit more about our TWAP algo?
Sure. So again, our core algo has always been what we call our TWAP algo, which is sort of a misnomer. It sounds very vintage, a TWAP. It's like very circa like 80s or 90s. And that's not exactly what it does. It's sort of a basic placeholder name that's mostly descriptive. Our TWAP is perhaps, and I'm not going to say it is, but it's perhaps one of the most battle-tested algos in the crypto space, seeing billions and billions of flows having gone through it over the years. It's been refined and we've been tuning it, and it's sort of something we do constantly. But looking at that algo, what it does, it isn't a simple metronome that fires off market orders at prescribed periods. It's something that's been very fine-tuned. It's most of its flows are passive. Again, it depends how clients use it. We have clients that leave multi-month TWAPs that are highly passive. And then we have clients that sort of contemplate using a market order, but instead do use a very fast TWAP to sort of try and beat the market order. So it's used for a lot of things. It does what its namesake does. It sort of breaks up a large order into smaller pieces and releases them into the market on a roughly linear scale. Works things passively. If that's not sufficient, it'll aggress. If that's very successful, it'll go dormant. So the TWAP itself is something that's sort of our bread and butter, is tried and true. But to your point, Josh, what we've been noticing over the past, call it season, out of summer and into something cooler than summer, that where we are today, liquidity has changed, both in the majors and in alt. So to help our clients navigate those markets, and sort of as I alluded to, we have clients that do leave very long dated algos with us to navigate those shallower markets, especially in evenings and especially on weekends. We've rolled out a VWAP algo, and sort of what we've basically done is we've built on the successful groundwork foundation that is our TWAP, and we have our data science team, and they've looked at data over the past several months on a rolling basis, and they've isolated sort of volume curves, sort of 7-day week granularity down nice and fine, and they looked across assets, and we've noticed that their patterns, the variance amongst assets is statistically insignificant, but within various time frames, there's a lot of stat sig variance over time from minute to minute, hour to hour, day to day, that we've been able to shape into what is effectively our TWAP algo. But now, instead of executing on a purely linear fashion, it's curvilinear. It'll sort of curve along and progress along with market volumes. The idea there is quite simple, and again, borrowed from tried and true practices in TradFi. We'll trade more when the market is historically more active, and on evenings and weekends, the market is less active. We don't dial down to zero, but we will sort of maintain a level that's sort of in line with the ambient level in the market. Again, as you mentioned, we're here working hard to try and get our clients the best possible outcomes.
Yeah, super. That's a great overview. Thank you so much. So I guess you had mentioned that the algo trades more when the market is active. So just going back to kind of the discussion around those volume curves, what kind of nuance do we have in terms of how the VWAP will look at volumes for weekends versus like high liquidity events, such as like, I guess, month-end events or quarter-end rebalancing? Are those events all taken into account as we've created these volume curves?
So we've looked back over multiple months. So those are included. We've narrowed it down to sort of 7-day week shape. We haven't gotten more granular to have a different shape for quarter end and month end, or on non-farm payroll Fridays versus a regular Friday. What we do capture are the variances, say, between 3 and 4 p.m. Eastern around BRR. Our data science team, I think last year, put out an interesting piece, or maybe David put out the piece, but there was a piece that Coinbase put out looking at certain bits of seasonality that occur in the market right after 30-minute candles print. So items like that definitely percolate in to our volume curves. And the goal here is to sort of trade more when the market's more active, such that the market can absorb greater flows with less market impact. And then obviously the converse is true. If the market is shallower, tends to trade less, we will ourselves, trade less on behalf of those clients using the algo.
Perfect. Yeah, that's helpful. Thanks for that color. I guess I've heard you mention in the past that the launch of our VWAP really unlocks new possibilities for our ever evolving algo suite. So I guess following the VWAP, what could you see expect to come to market in the next 6 to 12 months?
Sure. So the initial target audience of our VWAP are the clients that, as I mentioned, leave multi-month algos with us, or even algos that run, sort of overnight, or even a 6-8 hour window could benefit from having that shape. And having that shape also injects extra randomness into the order sizes and such. So that addresses sort of market liquidity and those clients leaving those types of orders. We've had lots of clients come to us and want stops. It's the favorite things for clients to beat us up that they want. And for anyone that's sort of, service clients with a stop-based service, they're going to beat us up once it goes live, because it's very sensitive, obviously, to get stopped. And in our world of crypto, with markets that very thin, they trade 24/7, and our smart order router is multi-venue. How do you monitor and measure and execute a multi-venue stop? We have a solution. We have something we think are good solutions. They are sort of locked in something we're working on actively. Something will pop up sort of this calendar year. Might it land this quarter? That'd be a bit of a stretch, but there's something we are working hard on this quarter. May land an early MVP this quarter, but it's something we will have by Q4. It's again, sorry to jump into Josh, but it's to do it right and in institutional size. We could have a single venue stop, which many retail venues have, which is simple: if touch, execute. But on a larger order. We're going to try and do a multi-venue fill, and if we fill your entire stop at better than your stop price, and it only printed for $10, you'll be rightfully upset with us. So trying to make an institutional sized stop viable is sort of why this is a challenge for us and why it's taking us the time it's taking us.
Yeah, it's interesting. I feel like, folks who come from the traditional markets are used to having algo suites from so many different bank providers that have like 10 different algos. And I guess, what is it about, from your perspective and what, in your experience, like what is it about crypto that makes algo development so much more challenging? Or like, what are some of those struggles that you see relative to like an equity algo? Because I do think they are so different, which is why it takes time to even get to the VWAP, for instance.
Yeah. So equity land, where you have NBBO logic and you have dark pools, there's sort of a structure to it that's all constrained, and they're guardrails, and it's known knowns. It's low latency, very deterministic. Those are all things that don't apply to crypto. We are moderate to high latency with cloud-based services, not just in the US, but globally. Some hosted, obviously, bare metal locally as well. You have dispersion of prices that are natural because of the pre-funded nature. There will be our markets themselves in our smart order router. Our median touch price in Bitcoin and Ethereum is negative most of the time, and that's simply because there are inversions that exist. Not true arbitrages after fees, but there are many venues that will be priced sort of because of an imbalance. If people are looking to buy crypto in some place, but there's no sellers because there's no inventory there, prices will skew and be biased. So having those skews in place and the latencies to take care of are challenges. We have an operations team that is constantly rebalancing dollars and crypto in various places to sort of enable our smart order router to do the magic that it does. It's not easy. It's not zero risk. It's what makes it some of our secret sauce there. And then there's the latencies. How do you manage around sort of that non-determinism that exists in our world? That's something that we factored into our smart order router.
Yeah. And great shout, I think, for our ops side too, as well. Everyone who works on the back end, it's like incredible work when I first joined here to see how hard everybody works to make sure that the right assets are on the right venues, et cetera. So great shout there.
Global team, 24/7 holidays. Yeah.
Yeah. No holidays, even on Christmas, New Year's. So last one, I guess, for you is how can clients who are interested in accessing the VWAP, how can we turn them on? What's the best way for them to get that access?
Sure. So we are in production. We've put through dozens of trades in production. We're monitoring them. All lights are green. For clients that want this ASAP, reach out to your sales coverage and we can get you opted in. And for clients that are more patient, it's coming to your Prime desktop shortly, where we'll sort of opt in all clients in the next week or two. We just like to roll things out to clients, get initial feedback, make sure everything's ticking and talking the way we like it before we go out to GA.
Perfect. Thanks so much, Rick. Really appreciated hearing more of your insights. We will hopefully have you back on here soon to talk more about all the magic you guys
We'll talk stops. Excellent. Thanks, Josh.
Thank you. So for those who are interested in accessing Coinbase's VWAP, please don't hesitate to reach out to your sales rep or anyone really directly on this call, and we're happy to help make the proper introductions. All right, now on to you, Georg. What are some of the market movers and the news headlines that have caught your attention this week?
Yeah, thanks, Josh. So starting with the majors, BTC and ETH, the market did spend some more time consolidating here. And despite looking relatively fragile at times with BTC trading down to 28,500, we actually held at that level and it found some support there. And that level actually also coincides with 100 DMA. According to CoinShares, there were about $107 million of outflows from crypto ETP products over the last week. Primarily, that's driven by BTC, which I would read as essentially some investors temporarily becoming impatient or losing a little bit of confidence here, given just how long this phase of consolidation has taken that we've been in. And then the other aspect is that we started hearing more frequently that there are some worries out there that, given how, let's say, crypto was sidelining while equities were rallying, that if stocks were to drop, they could take crypto with it. But actually, having said that, if you look at the price action over the last couple of days, that was very impressive because we actually had a pretty significant, or not insignificant at least, rally in crypto, I'd say, at least in the majors. And at the same time, equities were definitely under some pressure. If you look at BTC and ETH dominance, that's been going up slightly to around 70%. But I would still say that most of the attention in the market or the focus was on altcoins. So just to go through a couple of examples, Rollbit, the crypto casino token that was so popular in the retail segment, effectively more than doubled over the last 7 days. And then you had some of the DeFi 1.0 tokens that had done reasonably well over the last weeks and months, like Maker correct a little bit. So Maker, that actually happened despite them increasing the DAI savings rate temporarily to 8%. But, I think ultimately it's more of a technical correction here and similar in comp as well. That one was down 15% on the week.
Got it. Thanks for the overview, George. Especially, I love when you talk about the alts. I feel like we spend a lot of time talking about BTC and ETH. So hearing just some more alt color, I know our clients appreciate that. So thank you so much. I feel like in crypto, we always also say like, hey, this is a heavily narrative-driven market. So really, as we ultimately gear up for the fall, the end of summer, et cetera, what are some of the main narratives that you're hearing that have caught your attention most?
Yeah, so for sure. So I think that the big one is obviously that's dominated the first half of the summer after the headlines come out, the Bitcoin spot ETF with a number of applications now with the regulators. There's actually a decision coming on the Bitcoin spot ETF filing by 21 Shares and ARK Invest on August 13th. But I guess it's probably not unlikely that we will get a delay here. But definitely something to keep an eye on. Outside of that, some were talking about the so-called ZK wars. So essentially the competition between ZK Sync, Starkware, Polygons, ZK VM, and so on for users. That hasn't really quite taken off yet, but I think it's definitely a major theme to watch. And that also connects to the bigger narrative or theme of, ETH, the ETH ecosystem and scaling plays. Looking at L2s, such as Optimism, for instance, or Base as well. And actually, in that context, ETH futures ETFs have suddenly taken center stage as well. So there were at least 5 applications from different firms getting filed within a 24-hour period on August 1st. And a few more submitted last week. So, I think the race is definitely on. And I think there could be also some quite exciting things coming for the ETH ecosystem.
Yeah, well, I feel like we've heard a lot of more headlines talking about hitting with like ETH ETF applications. And I feel like that's just continues to be a bold up case for where we're headed to the end of the year, especially if we're looking to get something in BTC. George, I think there was also quite a bit of conversations around like USDT depegging. It seemed like it happened a few times over the weekend on centralized exchanges. It seems like the discussion was there wasn't a clear reason as to why. And it seems like Tether market cap has only been climbing, which seems like a bit of an anomaly. What's your take? What do you think is going on here?
Yeah, so stablecoins definitely been another interesting topic. And as you say, a lot of rumors going around Tether specifically over the last week. So just regarding the latest volatility in USDT, I guess, first of all, the question is how do you define a depeg? Because arguably the assurance of a one-to-one redemption is still there. So I would just probably characterize this as temporary weakness or some volatility. Although having said that, obviously there are some anecdotal reports or anecdotal evidence, you want to call it that redemptions are taking a little bit longer. But one other thing, for instance, is that if you look at how much, if you want to say depegged, that actually was on Coinbase Exchange, for instance, it only traded about at a discount of roughly 20 basis points to the US dollar. So it was not very large, I would say. Now, in terms of the reasons, definitely agree with you. It's a bit elusive. One theory that I've been reading about on crypto Twitter was that Binance, allegedly, according to on-chain analysis, was selling off some chunks in USDT to put that into DAI, but that has happened over the last couple of weeks. So I don't think that per se itself would cause any kind of or much volatility in stablecoins, just given the kind of liquidity that is there. But it's more again, that going viral on crypto Twitter, which could have the impact. There was also some speculation on Twitter regarding Huobi and that allegedly, USDT balances of users might not be 100% back. But again, at this stage, these are all just rumors circulating on crypto Twitter. So I think it's something to keep an eye on. But in the end, I think we have seen so many episodes of FUD surrounding Tether. And, in the end, this might just be another one of those where nothing much happens in the end.
Got it. Are you saying, George, that crypto Twitter is not real life? I'm just joking, but yeah. But yes, thanks, George. Thanks so much. And Sid, I know you've been paying close attention. I know we've talked in passing just about the PayPal news on Monday. News that it's issuing a stable coin via Paxos. So could we get your thoughts on the implications and what this announcement means for the crypto ecosystem, maybe more broadly?
Yeah, I think, obviously in terms of awareness, it's a great thing. PayPal, obviously with their global user base, will be exposing crypto rails to a large population, which is obviously great. It is interesting in terms of timing as well, obviously with the USDT announcing their kind of bumper operational profits last week of over $1 billion. Obviously, there's attention on how much money in crypto is earned via just U.S. treasuries, with the interest rate. And also with the issuer itself. The issuer is Paxos of the PayPal stablecoin. Paxos was previously had its own stablecoin. It still does, the Paxos dollar. Previously was also the issuer of Binance USD. So they've been doing quite a few of these, and they've open sourced a contract. It's on Ethereum. A lot of folks were looking into it, digging holes in it, et cetera, in terms of how it's designed, the efficiency, and things of that nature. But yeah, that's the TLDR is, in terms of awareness, it's great, but TBD in terms of the follow-on impact.
Got it. Yeah, it'll be interesting to see which exchanges which centralized exchanges, I guess, offer order books using the stable anyway. So, but certainly something to keep on top of, especially given that it's PayPal, such a recognizable brand. It has so much credibility, which I think offers a good thing for the space. Thank you for that, and great update, George. I always walk away with our conversations with such good insights, and today's no different. So thank you. Now on to the macro. David, I know it's been a busy week in terms of macro with the downgrade of U.S. Treasury debt from Fitch, and the upcoming CPI print. What's really caught your attention this week?
Yeah, thanks, Josh. I'd say, among the plethora of events we've seen, probably the increase in the treasury supply was the biggest driver for markets last week. For those who weren't watching, what happened was the U.S. Treasury increased its quarterly bond sales from $733 billion to $1 trillion for Q3. And that includes around $103 billion on the long end of the curve. That sent the 10-year up by around 25 bips, which is a pretty meaningful move. I'd say the biggest concern there is that this could mean a liquidity drain, which is why, because a lot of stocks were kind of overvalued already, we saw a pullback from those markets. To be fair, though, I think it was a pretty orderly move. And, you kind of saw the 10-year overshoot. And after that, markets kind of recovered a little bit last Friday after non-farm payrolls actually came under expectation. So, I've been arguing for a few weeks now that investors really should be playing these things kind of defensively, but I think it helps that at least from short-term positioning kind of point of view, that risk is moderating. Plus, the break in the dollar strength trend, I think is very good for crypto. As far as for inflation tomorrow, Thursday, the Bloomberg survey is forecasting a median 3.3% for July. You can see our slide too with the Cleveland Nowcast showing that suggests there's around 3.4% for the headline number. But I don't think that's going to be as important as the core CPI, which should show some sort of deceleration there. We've been seeing services stabilizing, forward-looking indicators on housing seems to be trending back to pre-pandemic levels. I think for me, that's what's most important.
Got it. So I know everyone's talking a lot about the much discussed soft landing scenario in the U.S. I saw that there were multiple bank research arms last week, I think late last week, adjusting economic views to account for greater likelihood of avoiding a recession. I know from your tone in the past that you've been a bit more cautious. So what are your thoughts here?
Yeah, I'm not terribly I don't think it pays us a lot of to pay a lot of attention to those kind of moves. One, because I think this is kind of more of a formal recognition that this is a macro trend that's been going on for a while. A lot of investors have been kind of saying that we're more in a Goldilocks situation at the moment, low inflation, stable growth. Also, like Goldman, Morgan Stanley, they actually have maintained that view for a while that the U.S. could avoid a recession through most of this year. So, personally, I haven't shifted terribly from my perspective, which is I think it's a very fine line between recession and soft landing. But it's very clear there is some divergence between what's going on with the U.S. in terms of its economic prospects and what's going on with the rest of the world. A big part of that has to do with the fiscal spending in the U.S. And that kind of goes back to my first point about how we've been seeing an increase in the Treasury issuance supply. Between the CHIPS and Science Act, the Inflation Reduction Act, the U.S. is going to be spending an additional $2.1 trillion over the next few years. That's huge. To me, that's the biggest thing to focus on, because that means the Fed is going to need to maintain a very loose monetary policy to manage the cost of servicing that debt. And even if we do avoid a recession, very likely, growth is still going to be pretty subpar, which to me means that we're going to need to see the Fed stepping off this tightening path by early next year, if not sooner.
Yeah, interesting. And there's a lot of what you said is interesting. One, I think, with respect to whether or not the Fed holds to its dual mandate, whether or not it sticks to its inflation aims, I think that's interesting as well. But I think turning an eye to Asia for a sec, because you mentioned this dichotomy between the US and the rest of the world. Yesterday's PPI and CPI numbers, I think, got a lot of headlines and the FT, et cetera. Though inflation actually beat the survey figure, and stocks in Asia ultimately shrugged off that data. But what are your expectations, if you have them, for China monetary policy, given some of the ongoing concerns around property developers, inflation, et cetera? And could this be good for BTC and potentially US dollar stables?
Yeah, I think the biggest takeaway is what you kind of mentioned, people shrugging this off, because actually, let's just go through the numbers first. So the headline prices in China came down by 0.3% year on year in July. Though in monthly terms, it was actually still inflationary, not deflationary. But I think that that's part of the reason why markets reaction were just so muted. The real story here is that it just doesn't seem like the deflation print is going to be the sustainable trend going forward. I think that, goods prices are going up, for example, wheat in the region is being constrained by the war, rice, the prices there are picking up due to supply risks. So, I would say overall, markets are actually more dependent on what's going on with the liquidity situation. And we are seeing that the authorities there are unlocking a lot of that. So, that money is going through the economy right now. I wouldn't expect that, risk assets to actually sell off on the back of this print because the liquidity is there. But overall, I would say it's probably a good sign for the U.S. too, that if there is a deflation in China's PPI, for example, that could put a cap on our inflation, and at least in the short term, which, it kind of goes back to my point about loose monetary policy. That's an environment that's probably going to be very good for Bitcoin, for example, because that means that we're going to see an erosion of the purchasing power that the US dollar has, which the reciprocal of that really kind of puts Bitcoin up as a strong alternative to the traditional financial system.
Yeah, that's a narrative, certainly, that I know we spent a lot of time walking through as the banks were having problems here, and one to really pay attention to. I guess the last one for you is, I know we have Jackson Hole ahead of the end of the, at the end of the month. What are some policy implications or headlines you're looking for? And I guess my question for you is, if you're a betting man, are you placing any chips on headlines coming out indicating that we are near complete on these rate hikes?
So first of all, this year's Jackson Hole is going to take place from August 24 to 26. The title that they're promoting on their website is Structural Shifts in the Global Economy. But there's still no formal agenda here. They usually post that about a week before all this starts. After the last FOMC meeting where the Fed basically fed very, very, very little. It was probably the least amount of information I've seen conveyed in any Fed meeting all year. I think a lot of people are kind of looking forward now to Powell sending a stronger message at Jackson Hole. The board, of course, still seems pretty divided, but I've said this on the call before. The chair of the FOMC, the chair of the board, has extraordinary authority. And in my view, Powell is dovish. We've recently seen him endorse the idea of rate cuts in 2024. I think we're going to watch for signs at Jackson Hole that they believe the current policy stance is already very tight. For example, if they talk about quote unquote like long and variable lags from monetary policy, that's going to be a very big clue in my mind. I think that the market already has all but priced out the possibility of a hike in September, and I believe that is in fact the right call. For me, I'm going to watch to see what else they have to say, given that now we've also got this downgrade from Moody's on a lot of the regional banks as well. That's a piece of new information that they didn't have previously. They've been so far kind of shrugging off the idea that the banks are an issue, but I think there are a lot of people out there who don't think that problem has been fully solved yet. So I think that's going to be a big part of the conversation as well.
Yeah, thank you. I saw that, I think that the bank's downgrade kind of didn't get too much attention. And I felt like that bank's downgrade was a big note in terms of which banks to watch for as well. I mean, there were some really big banks on there. So thanks for bringing that up. Wonderful. Thanks for covering so much, David. Appreciate it. Now on to you, Trish. Flows. So I know we're in the middle of the heat of summer, but what interesting flows are you seeing and how does this help inform your broader market picture?
Thanks, Josh, and hello, everyone. So kicking things off with flows, I mean, frankly, things do remain in line with previous weeks and the last month or so. To that headline, we continue to see dollar cost averaging in both Bitcoin and ETH, but doesn't feel like any net new clients are really reactivating and re-entering the space that we saw in previous years. Continue to see opportunistic selling of alts, and some of that includes rotation into ETH. And we've also seen over the last, I'd say, 6 to 8 weeks post kind of BlackRock ETF announcement, we've seen clients enter the basis trade on Bitcoin. That's currently annualizing around 6.5% to 8%. And clients in the last week or so have continued to kind of add to their positions on that trade or slightly kind of marginally scale out of that. As George mentioned earlier, prices have been consolidating and frankly flows have really followed and stayed in sync there. One thing I did want to really touch on in terms of, you mentioned this summer, I really wanted to take the opportunity to delve in a little bit deeper into that and kind of analyze, how truly is summer liquidity and how has it reacted to previous years. So as you can see on this first chart, this is a monthly volume broken down for every month since 2018. You can see, the year to date 2023 in red in the middle there, and that's kind of averaged year to date something just about 47% below 2022. You will see that no surprise to see 2021 and 2022 volumes very strong. As we saw. Generally, the narrative of institutional adoption really take hold, and of course we saw back end of 21 with the run up to 60K. We saw China headlines in May of 21 causing that big spike there of peak kind of volumes there. So you can see that it is a little bit noisy. We've had some very strong years, and this seems to be something kind of just below that, but obviously well above some of the prior years of 2018 to 2020. Now, on the next slide, I kind of took this a step further and actually normalized all of this. And as you can see, it's not really a pretty picture. Whilst there is some correlation between 2018, 2022, and so far in 2023, frankly, with so much noise, it's hard to really conclude that there is predictable liquidity cycles in crypto. I think there are certainly weekly and hourly cycles that can be predicted, but when you zoom out and look at it kind of more on an annual basis or certainly kind of monthly basis, it can be very unpredictable. And really, crypto just has shown not to have the same maturity thus far compared to traditional markets such as equities, and that's no surprise. I think every year seems to be getting bigger, better in terms of that maturity, but I think there's still a long way to go. One of the kind of key kind of drivers for that maturity I'll be looking for over the next kind of months and quarters ahead is maybe more traditional segments entering the space, like more quant hedge funds, systematic traders, and so on, where they will kind of have similar cycles to what you see in traditional markets. Finally, on the next slide, really wanted to just touch on seasonal returns. This is something which Greg Sudden brought up a few months ago. And I found it really interesting. So I just wanted to return and update everyone on the podcast. So as we can see, July closed down 3.9% compared to the 5-year average, which typically returns 17.92%, positive 17.92% for the month of July. Now, you can see there in 2023, it's not really bucked the trend of historical averages. And so what I would when I looked at this, I would really say, we have to be prepared for an unpredictable Q3 or Q4 this year in both the liquidity and volume cycles, but also in terms of returns. And definitely pay attention to some of those narratives that both George and David touched upon.
Yeah, thanks, Trish. I know you're an OG in this space, having been in a trading seat for a few years, which I feel like makes you an elder statesman in this business. So walking through that seasonality component is super helpful. And I feel like personally, that seasonality component is largely driven, when people say like sell and may go away, I feel like it's institutional style PM and traders who take the summer months to tend to personal and non-work related matters. And maybe crypto in the past just hasn't yet had, as you mentioned, as much institutional adoption, which we would expect to hopefully change in the years to come. I think I saw yesterday as well, one thing I want to ask you was a chart that showed that BTC dominance, and George mentioned this as well, was back to being greater than 50%. Bouncing back from lower levels in July. So what are some notable trends in alts that you're noticing?
Yeah, certainly to touch on this briefly, I think, as we saw, the Ripple headlines resulted in short-term, catalyst for a rally in the altcoin space. And that, and that was also a retracement of the, 20 to 25% sell-off we saw post the SEC filing suits. At the time, of the sell-off, we saw a lot of de-risking of alts and rotation into majors, and vice versa, post the Ripple headlines where, a lot of inflows. But as mentioned earlier, frankly, at the moment, we continue to see dollar cost averaging from the crypto natives and VCs, but no net new money is really flowing into alts. It does feel like, the focus continues to be on the majors, and this really does align with Bitcoin dominance. Having said that, I think, we are seeing, or certainly feels like one of the narratives I've made me think twice was, we are in what a lot of people can consider a crypto winter. And we're starting to probably see coming out of that phase, in my opinion, where we may be entering what few people have termed a builder's spring. We've seen a lot of development activity amongst the crowd, and I think that would be quite interesting to see how that impacts some of the L1s, like, of course, like Solana has a fantastic developer community and so on, and so it'll be interesting to see how those tokens perform over the next few months. But for now, flows certainly seem to be concentrated on the majors, and haven't seen any flows to really suggest that there is any form of direction over the next few months in the altcoin space.
Yeah, I think you covered this as well, and I tend to agree with you on that. But I do think, like, following the ongoing ETF news, so George mentioned this as well, with ETH seemingly back in focus. So I guess, would we expect to see an uptick in new institutional demand? Like, what does that outlook look like in terms of the conversations you're having? Maybe for folks who aren't investing or aren't into the market today, but are actively looking to get there as soon as, we have some more news from the space.
Yeah, exactly. And, as you and George mentioned, we saw a number of filings, I think since the start of August. And that included some of the biggest issuers like ProShares, Bitwise, VanEck, and so on. Now, these are Ethereum futures-based ETFs, so they will be they'll be doing the hedging on the CME of Ethereum futures. Now, I recall when the Bitcoin futures ETFs were launched, and BITO being the first to launch and the most significant by AUM at this point. But we saw a big run up in BTC futures on the CME, and that created a good basis opportunity for clients who are happy to enter the space and run some market neutral strategies. We saw that from a lot of TradFi institutions where they came in, bought spot and sold the CME futures. So we may see something similar with the Ethereum ETF. I think a lot of them, or certainly the first review by the SEC starts due on like the 11th of October, and that's a volatility shares application. And then there's a number of other applications on the 16th and 17th of October. So, if we refer back to, again, what happened on the Bitcoin futures ETF and BITO, when that was listed, I think that the opportunity was bigger, something like 18 to 20% annualized premium. So that could definitely open up some basis opportunity for those looking to enter Ethereum. And what was great about the Bitcoin opportunity was it was net new money from net new clients coming into the space. And now that they've kind of had the opportunity, they've kind of run the trade previously, I feel like this could be another opportunity to get in front of those clients and perhaps see the similar flows, or at least they should be prepared to see similar possibilities and opportunities present themselves.
Yeah, great shout. I think, we, as Greg has done this for many years as well, I think that the basis trade, if, those premiums get to 18 to 20%, I mean, I would be salivating. I imagine the hedge funds, traditional institutional folks are salivating at the opportunity to be able to get in on that action. So interesting. And thanks for walking us through that. Thanks, Trish. Now, Sid, on to you and all things DeFi. What's been on the top of your watch list for the week?
Hey, well, some key things. One has been just today, there was an announcement from the Aptos team of a potential collaboration with Microsoft on building, AI and blockchain-based tools. TBD on exactly what comes out, but they've listed a whole bunch of things that they're planning to, work on together. So that's something on the kind of new technology front development. Within DeFi itself, the ongoing Curve finance situation is one thing that we've been keeping an eye on. Last week it was mentioned, Curve was exploited for a few pools based on the Viper programming language, and there's also a follow-on effect with the Curve's founder, who had a pretty massive loan out from the Aave protocol. And over this past week, basically what's happened was the founder sold 8 million CRV tokens to 5 individuals over the counter trades, OTC trades, and then also the exploiter themselves started to return most of the funds to Curve, the DAO, in exchange for 10% bounty. So they got to keep 10% of the exploited amount. And in a pretty interesting twist, they also sent an on-chain message while they were returning the funds, saying that I'm refunding you not because you can find me, and maybe it's a lot of money for a lot of people, but not for me. I'm smarter than all of you. I'm not sure who's behind this attack, but this is the nature of on-chain exploits these days. Most of these individuals send and receive messages on-chain and that are visible for everyone to see, and so always entertaining from that side.
Yeah, not the most humble, and sounds like certainly not the most sorry. So that's interesting to see. I saw that message and I thought, wow, this was like a bold move. Now, on the back of the Curve exploit last week, we saw also like some ETH DeFi tokens trading weaker. I think they had reached recent highs, at the end of July. So what are some ongoing token implications as we kind of wait to continue to see the Curve situation play out?
Yeah, a few big ones to consider are basically lending protocols. Aave was the protocol where the Curve founder had a significant portion of his CRV and had borrowed a bunch of stable coins off of the back of that. And there's been a lot of discussion on the governance forums in terms of freezing borrows on CRV, setting caps on borrow amounts overall for the protocol, and other such discussions. So that's a kind of situation that's in flux, just so that the protocol doesn't have systemic risk issue to it, even though it's a small portion of its overall TVL. They just didn't want to accrue bad debt. So Aave, other borrowing protocols, recently the founder also opened a borrow position on Cream Finance. And then in terms of on the trading side, Uniswap and Sushi are two things, two exchanges that have benefited a little bit from stablecoin flow that has kind of come over from Curve. There's an uptick in stablecoin volume on both of those exchanges, and even on the Curve, the main Curve tri pool, it also reflects some of the stablecoin discussion from earlier, where it's become pretty imbalanced. There's significantly more USDT than USDC or DAI, and there's about $100 million worth of capital in there. So that's also something we're keeping an eye on.
Yeah, interesting. I noticed that too as well, that Uni and Sushi were trading higher, slightly higher, like I think up 2 to 5% or something like that. So that is, thanks for giving that a shout. And I know you've been also paying attention to all the exciting things that we're doing here with Base. So did you want to walk through maybe some of the high level numbers and what we're seeing?
Yeah, absolutely. A pretty exciting day. In fact, today, official day, Base mainnet, open for everyone. It's being kicked off with an event called On-Chain Summer, which is going to run for the next few weeks, which is going to highlight several things that folks can do on-chain, including on-chain art, music, gaming, other such things, and a lot of interesting new developers are deploying new kinds of experiences in collaboration with this. So it'll kind of roll out over the next few weeks. But already we've seen quite a bit of traction in terms of high-level numbers. There's an NFT that folks can mint when you participate in bridging over to Base, and you agree to participate in On-Chain Summer, and we've seen over 115,000 mints of that NFT already. And in terms of net value, there's been over almost $150 million worth of capital that's bridged over to Base. A large part of it being ETH, but expectation is probably we're going to start seeing some pretty significant stablecoin action as well soon. And then most interesting, perhaps from the technical front and new use cases front, is also the integration with Coinbase Wallet. So when folks are bridging over and participating in On-Chain Summer, there's a QR code that folks can scan to send an on-chain message to the On-Chain Summer account, which you just have to send a message saying GM. And if you do that, you get a message back. And this is kind of one of the first large-scale uses of on-chain messaging on Coinbase Wallet. It's powered by XMTP protocol, and we're seeing quite a lot of message flow happening on-chain. You can see that on the Explorer and also in data services. So we'll see how that develops as well.
Perfect. Yes, exciting, and we're so excited about all the developments here that are happening with Base. So pay close attention to that. And I think it's interesting. Hopefully we get the next million and the next million developers, next billion users on chain. So thank you, Sid. I think that's it from us. A big thank you to everyone who joined us for this week's episode. That is it from us here in the studio. We hope you have a wonderful rest of your week and see you bright and early next Tuesday.